Welcome to the Dream Huge podcast, where we'll talk with real estate investors, entrepreneurs, business leaders, athletes, and more to inspire you with their success stories so you can work hard, never give up, and dream huge. And now, let's start the show.
Yo, what is up, everybody? Welcome to the Dream Huge podcast. Man, super excited to be here today. We love to share success stories from other huge dreamers, folks in the real estate business, entrepreneurs, movers, shakers, influencers, and more. And hopefully these stories will help to motivate and inspire you to also dream huge. So today we have our very special guest. His name is Stewart Heath. How you doing, Stewart?
I'm doing great. Thank you so much for having me, man.
Yes, thank you for coming on. Thank you for making the time. Stewart Heath is a serial entrepreneur of 35 plus years. We're going to dive into that as well. He is the CEO of Harvard Grace Capital. He is partnering with busy professionals who want to create passive income through real estate investing. So, Mr. Stewart, please tell us a little bit about yourself and what it is you do there at Harvard Grace. Let's start with that.
Well, just to expand on what you were just saying, I am a CPA. I've been a CPA for I think 34 years or so, and I'm a CPA because my dad was a CPA, and it seemed like a good thing at the time. And then I get out of college and I go to work for one of the big international firms, and I get about 4 years into this and like, oh, I'm a lot more entrepreneurial than most of these other green eyeshade guys around me. And don't get me wrong, I got the utmost respect for accountants and CPAs. It's just it just wasn't really in my DNA. Although don't regret a minute of it. Fabulous training, and I continued to practice. For many years up until about 2010. And then even came out in 17 and had a fractional CFO practice, all the while wanting to get into commercial real estate. I'd done some residential real estate from 2000 through 2010, gave a lot of it back to banks back in 2009, and then got into commercial real estate. All the others was residential. I'm not a big fan of residential if I have to manage it. And I don't like managing residential real estate. Excuse me. And so was able to pivot in 2020 to commercial real estate, syndicating the equity and building proper reserves and structuring good sized deals, say $5 to $15 million deals. And really that's what I do now. I pretty much half my time is looking for new deals.
Excellent. How valuable is it that you are a CPA, but also an entrepreneur?
Well, honestly, I can't imagine it any other way, just because, how do you walk in somebody else's shoes? I think it's hugely valuable. I think the CPA and the financial analysis comes in huge in doing the real estate analysis and just other business analysis that comes along with it. Where it wasn't so helpful is when I started raising capital from other people, which is essentially a sales and marketing function that came as unnaturally to me as anything I've ever done in my entire life. But so I started that journey. I joined a mastermind about 3.5 years ago, and I applied myself. I learned new techniques at 57 years old, and we're not setting the woods on fire, but we've raised a little more than $10 million in capital in that period of time, and we're just getting started. So,
excellent. I heard some famous entrepreneurs say that the successful entrepreneur must be their very own CFO as well. Even if they're not well versed in it, you have to know your own company's financials like the back of your hand. And I think
Absolutely.
that's where a lot of entrepreneurs fail. They have an idea, or they can grind and they can work hard, or they have a great idea and they bring it to market, but they lose sight of the most important thing, the financials. So I think that's huge. And I know we get, as business management majors or entrepreneur, even majors, you get a taste of those accounting classes, but a CPA is a whole nother level. And I think that is a great asset for you to have. There ain't no doubt. So,
I used to advise my clients, if I can just add to what you're saying, that back when I was practicing, because it is, I don't know that I would agree that it's the most important thing, but it's foundational. You really can't grow until you know your numbers, until you're confident in what your numbers are. So I used to look, it's what you own, it's what you owe, and it's who owes you. Those are the three numbers you've got to have at any point in time. And and I believe that's true for any CEO, whether he's got a CFO or not. CEO still got to know his numbers.
wish somebody would tell the U.S. government that those same three rules, because
Yeah.
they keep printing it, baby. They must not be CPAs too much in, over in Washington D.C. But okay, tell us a little bit about what you are looking for on these commercial investment deals. What's your bread and butter?
Yeah, a Harvard Grace deal is essentially any deal that will cash flow from day one, after also providing a cash on cash return to our investors at a minimum of 5%. And that is a minimum. Right now our portfolio is delivering cash on cash at 9.5% per year, and that's just the cash side. Capital gains will come later, if not a cash out refinance or something like that. So in short, we are asset class agnostic, which means we will look at anything, and our portfolio kind of shows that. We've done office, we've done storage, we've done medical office, and we've done retail. Haven't yet found a multifamily deal that we're willing to do. Most of them are overpriced to be able to cash flow on day one. And it's the most popular asset class out there. Multifamily is the queen of all real estate, commercial and residential, and it's highly in demand. But we look for deals. For the one we just bought most recently in Birmingham is a medical office building. We got it at a cap rate of 8.75%, which means we're throwing off cash to our investors at 6.5% from day one. So we bought it 2 weeks ago. And on October 15th, we will be sending out a distribution of 2 weeks operations on that deal. So we do it every quarter, without fail. And if we can't see our way clear to do that, we don't do the deal. So that's our main focus is stabilized and recurring cash flows.
Where do you find your deals?
In the beginning, it was a lot of CoStar and Crexy searches and driving around, and we still put a lot of time into those tools. As you get out into the market, you make some relationships, and so we have a regular stream of off-market deals, or they might be listed, but they hadn't hit the market yet, and so we have brokers that bring us deals, and sometimes we like them, and a lot of times we don't.
Gotcha. Do you believe there may be a bigger upside to, say, a commercial property that is non-multifamily versus a multifamily?
I think that it's possible, and it all comes back to rule number one: is you make your money on the buy, not the sell. So if you buy it right, anything has a potential of having an asymmetrical or an upsized return to it. I think multifamily is probably the most liquid asset class of the commercial real estate. I mean, still going to take you a while to sell it if you need to liquidate it, but it's the easiest thing to sell. And that generally will lead to, on average, greater returns. I think that you can get pretty close to equal returns with less management intensive and perhaps a little bit lower cost structure with other asset classes like office or medical office. And I know everybody is still kind of freaking out about office these days, but it's the suburban office class that is actually doing quite strong. I just actually did a post that'll come out tomorrow about that from some research. Office has been on a 10-year decline, even before COVID. Central business district office, let me say. So Class A and downtown kind of stuff. Suburban office has been on an upswing for 10 years. Of course, it had a blip at COVID, but it's back positive, and this is just charting actual asset prices. But some of that is going to be because, office was declared dead in 2020, and now nobody's building any, and now that people are going back to work, there's not much supply of it unless you get into the central business district. We own a couple of suburban office buildings. We just love them. They stay full. The rents go up every year, and what I like about them is you get to put a nice 5 or 10 year lease on the property, and then you kind of set it and forget it. You go through, you make sure the irrigation works, the landscaping looks nice, and the building stays clean, and your tenants are happy. Multifamily, you're a lot of times churning those units every year, and it's a very different kind of an animal.
Yes. And I think, the fear of the residential investor jumping over to commercial is, the residential units they're so much easier to fill because we have such a housing shortage.
Yes.
So yes, it's almost an automatic fill as long as they're priced right and they're done nicely. Whereas it's a little scary to get in a commercial, especially if it's something that is a value add and something that needs filled up. What advice would you give to those investors?
We don't do those. We generally buy things that are stabilized. We look for value adds in a different way. Perhaps they are, under market rents. They've been mismanaged. And if we can still buy it where it's cash flowing day one, we're going to triple that cash flow by year 3. And we haven't had to move any walls or do an addition or anything like that. So that's what we call a management value add. I agree with those concerns. If you've got a commercial property that is not currently full, I wouldn't touch it for a couple of more years, especially if it's an office. All real estate is local. You make your money on the buy. You don't have any idea how long it's going to take unless to fill those spaces, and you got to ask yourself, why are they not filled? Because there's not a whole lot of space on the market unless you're in these downtown areas. My advice would be to steer clear of the ones that are not optimally occupied at this time.
That's great advice, Stewart. Thank you. And that's the type of investor that I am. Give me those turnkey properties. I'm scared of those projects, those question marks,
Right.
those uncertainties. Give me something that's, as you said, stabilized, and then we can go in there and only make it better. And I think that's great advice. I've seen folks fail doing that. They have these grand ideas and they start the rehab, and the rehab was underestimated, and they finally get the rehab done, and then they can't fill it up. Oh man, it turns into a disaster. These huge,
it's painful.
projects.
It's painful to watch, and it's painful to go through because I've been through it myself. Been there, done that, and lost the T-shirt, as they say.
Yep.
So
Yes.
yeah. I'm just looking for money, for cash flow these days. I'm not looking for adventure anymore. And what you see, the difference on our what we call boring deals is, we're going to estimate over the course of your holding a an IRR, a return on investment in the low 20s, which I think is fairly conservative. Where the value adds guys, they're out there selling you it's going to be a 3x equity multiple. You're going to have IRRs in the 60s, maybe 70%. And I don't doubt it. But the one variable nobody has control over is time. And just in some, we had at one of our properties, we had one tenant move out and somebody else wanted their space, and it was all great. It's ended up great. But to absorb another 500 square feet took almost a year because of subcontractor delays, and I wasn't doing it myself. I hired professional people, and you just don't know how much time it's going to take, and time will kill your interest costs, your other carry costs, and time will also impact the overall cost of the whole project.
Yes, time. Speaking of time, what is your average hold time?
Well, right now we still hold everything that we've done. We always estimate a hold time of about 5 years. However, most of our investors are on the same page as me in that, and now that interest rates have dropped, next year will be a year of refinance. And so we have several projects that we will refinance probably early Q2. We will pull cash out, give that money back to our investors on a tax-free basis, and probably in a couple of cases, they'll get all of their money back. And we're not buying them out. They're welcome to stay on for the ride forever. So to answer your question, I'm going to guess my hold time is going to be between 7 and 10 years. We're not a deal-driven shop. We don't have to do a deal or anything like that. We think that there's a natural point in every asset's life when it's time to get out. You got a big tenant who's going to move out in 2 years, or you're going to have a new roof need in 3 years, and maybe it's time to go ahead and start looking at that exit at that time. But right now, it is our plan to refinance and distribute, refinance and hold indefinitely. But we always provide calcs at 3 and 7 years in our capital raises, just to say, hey, this is what it looks like. Mm-hmm. If we're successful, we will have a refinance around year 3, and you'll have all your money back, and then we'll go do some other deals while you're still getting cash flow on this deal.
Fantastic. Hey, Stewart, tell me about this, what you think about this idea. So we have this surplus of offices in your central business districts, okay? We have a shortage of housing in those same areas, residential housing. And this is a city by city, state by state basis. These cities could go in and change the zoning on those commercial properties. And we could address 2 problems at once. We could turn that surplus of downtown office building space into residential space. What do you think about that idea?
I think it's a fabulous idea. I think the execution side of that can be very challenging. I think a lot of times these office buildings their footprints are way too large. The plumbing's never in the right place. And you've got you might have centralized bathrooms in a 10-story building, and that's just not how residential works. And if the engineers and architects can figure out a way to make it work without gutting the whole building and starting from scratch, I'm all for it. I think it's a fabulous idea. But yeah, I'm not the one that's smart enough to figure that out.
Right. Sounds like too big of a project. Sounds like too big of a project for us to invest in too.
Exactly.
But yeah, exactly. If everyone doesn't mind sharing a bathroom, one bathroom per floor, back to the old college days, the dorm rooms, they had one bathroom per floor. We all got used to it. Yeah. And a lot of the high rises in your older high rises in these big cities, they still have that one bathroom per floor. maybe we'll get back to that as just an idea, But yeah, we're going to leave that to someone else who enjoys investing in those projects, because Stewart Heath and I love those turnkey
Absolutely.
opportunities, those stabilized assets. So, Stewart, thank you for your time today. We're up over 20 minutes already. How can folks contact you if they want to learn more?
Best way to get to me is go to harvardgrace.com, just like it sounds. You can find all of my contact information there. I do invite anybody who's interested, use the Calendly link, book some time with me. I'll talk to anybody about real estate pretty much anytime.
Outstanding. Thank you, Stewart Heath. Thank you for joining the Dream Huge podcast. If you want, or you are interested in investing in real estate passively, get a hold of my man, Stewart Heath. And that's the thing about investing in real estate. It truly is a team sport. And Stewart is offering those opportunities, especially some of those off-market opportunities, and he can offer you opportunities that you wouldn't have on your own. You can go to scale with someone like Stewart, and you can find those properties which are cash flowing nicely. So thank you for your time, Stewart. Any closing thoughts? Any closing thoughts before I let you go?
No, I think always have opinions. I think we're in for an exciting adventure in the coming months with the Fed doing what they're doing now, presidential election. It's an option between two worlds. Take your pick. I think 2025 is going to be a very exciting year.
Good. Well, here's to an exciting year. Thank you again, Stewart Heath. Check him out at harvardgrace.com. Thank you for watching and listening to the Dream Huge podcast. Remember to like, subscribe, and share. And as always, remember the rules. Work hard, never give up, and dream huge. Let's see the guns. Throw them up there, baby. Yes, Stewart. Thank you, buddy. Thank you very much.
Thanks for having me, Pete.
Yep, we'll see ya.
Thank you for listening to the Dream Huge podcast. Make sure you subscribe so you don't miss any future episodes. For more inspiring content, follow us on Instagram and Facebook at Dream Huge Realty and on TikTok at Dream Huge Inc. Until next time.